Good morning, good afternoon, good evening, and welcome to the Geneva Association Conference on Environmental Risk and the Insurance Industry, jointly organized with Swiss Re. My name is Mariam Golnaraghi, and I'm the Director of Climate Change and Environment at the Geneva Association. Today, we have nearly 700 registered from around the world for this event. I would like to thank you all for participating and hope that you will find the discussions fruitful and insightful. Specifically, the agenda for today would include an introduction by Jad Aris, Managing Director of the Geneva Association, followed by a welcome address from Christian Mumenthaler, CEO of Swiss Re. We then move to the first panel on executive insights on environmental and nature-based risks as a core business issue for insurers, while taking into consideration transitioning to net zero, which will then be followed by a keynote by Sir Robert Watson. After a short coffee break, we move to panel 2, which will focus on looking ahead on how insurers can address the drivers and impacts of environmental nature-based risk moving ahead. I will also close at 4:30 p.m. Central European Time. Just a few housekeeping and information about the Zoom platform. This event, for your information, is being recorded, and the recording will be available in a few days after the event on the webpage of this event. All attendees will be muted by default. For the Q&A, you have two options. You can click on raise hand or write your questions by clicking Q&A button. And if you have any technical issues, please write a note to our support team on chat. Now, without any further delay, I would like to invite Jad Aris to officially open the session. Over to you, Jad. Thank you.
Thank you, Mariam. Good morning, good afternoon, and good evening. It is a great pleasure for me to welcome you to the 2021 Climate and Environment Conference of the Geneva Association. We offer our many thanks to Swiss Re for co-organizing this event with us, and in particular to Christian Mumenthaler, CEO of Swiss Re, and at least as important, Vice Chair of the Geneva Association. Christian will be giving the official welcome address in just a moment. I hope that you, your families and your colleagues are healthy and well. Here in Switzerland, vaccination campaigns are progressing and infection rates are improving, but many places around the world are still very much grappling with the pandemic. So our thoughts are with all of you who have been affected by COVID-19 in one way or another over the past 18 months. This is the first time the Geneva Association is organizing an event focusing on environmental risks beyond climate change. There is a growing awareness, including in the insurance industry, that the environment is deteriorating at an accelerated and worrying pace, mostly, like for climate, because of human behaviors. This crisis is taking many forms: air, soil, ocean, and water pollution, deforestation, biodiversity loss, all of it compromising food, water, and health systems. This deterioration is both a cause and a consequence of climate change. Moreover, there is scientific evidence that environmental degradation and biodiversity loss make it easier for infectious pathogens to transfer from an animal host to the human population, threatening human health. As many of you know, while there is today no consensus about how the coronavirus has appeared, this is clearly one of the hypotheses. And if we address environmental risks today, it is also because, as we have painfully learned from the pandemic we are hopefully emerging from, when we react ex post to large-scale catastrophes, rather than preparing for them, the human and financial costs are much more severe, and it is vulnerable populations who suffer the most. The world is increasingly aware of this, and the response to the pandemic in the form of massive government financial stimulus and rescue packages has reignited calls to building back better and for a sustainable and resilient recovery, including on the front of biodiversity preservation. Insurers are starting to take action on the environment, both in their investments and in their underwriting activities, innovating on insurance coverage to protect nature. The recent launch of the Task Force on Nature-Related Financial Disclosures, the so-called TNFD, the younger cousin of the well-known TCFD, should accelerate our better understanding of nature-related risk and enable more nature-positive outcomes for society. It is worthwhile to underline once again that climate and environmental risks bring not only challenges, but also opportunities for the insurance industry. Before we embark on our program, I want to extend a special welcome to our keynote speaker and renowned environmental scientist, Sir Robert Watson, former chair of the Intergovernmental Panel on Climate Change, the famous IPCC, and of the Intergovernmental Platform on Biodiversity and Ecosystem Services. Having chaired both platforms, he is in a unique position to comment on the interrelationship between climate change and nature degradation and the challenges of addressing them. We're all looking forward to his address. Thank you, Robert, for being with us, and thank you to all panelists for speaking with us today. I wish you all an exciting and fruitful conference, and I now hand it over to Christian Mumenthaler, CEO of Swiss Re and Vice Chair of the Geneva Association. Christian, the floor is yours.
Thank you, Jad. Thank you for these words. I hope you can hear me.
Very well.
Yes. Okay. Excellent. Thank you. So, welcome everyone for this to this session. It's a pleasure to make a few introductory words. And I really hope you're all well wherever you are, being aware that some countries on Earth are still in a very difficult position. And hopefully the new variant will not spoil the party in the rest, but hopefully we're out of this. So this is a daunting topic, Jad, even though we have worked a lot on all of that, because you defined it as broader than just climate change, environmental. But if you allow me, I will first talk about climate change, which is the easier part of it, even though it's super difficult, and then maybe go a bit beyond that. So I think probably because of the nature of our business, certainly on the P&C side, the insurance industry has actually been relatively early in understanding the risk of climate change, earlier than most other industries. So I still remember when I was a chief risk officer in 2005, the other chief risk officer in the forum we had, there was consensus that climate change was existing, and so that's 15 years ago. And there was little discussion, even across the world, across different cultures. I think it was accepted as something that is really happening. I know that Swiss Re, for example, we published something around that in 93. There's a full brochure on climate change from 93. But we haven't been very successful in moving the world with our warnings, I have to say. So finally, I see the world move, but it's not because of us, it's because of other factors, which I think we all have our own views on. I personally think a big part of that is that the populations all across the world are starting to see it in their daily lives. So wherever you travel, no matter what the political party is, when you talk to people on the ground, they usually see changing patterns. It's become something very serious, and in the last 2 or 3 years, a massive change has happened in the attitude overall. And I think we're beyond the tipping point personally, because the countries, many countries have committed to this net zero 2050, and 20% of the Fortune 2000 companies have also committed to net zero 2050, and they will force all the people, all the companies that deliver to them to go to net zero 2050, and so on. So I think that the snowball effect is starting to have an impact and makes me more optimistic. And so what do we have to do as insurers? I think we all have our role in the value chain. I think the first one obviously is our own operations, but that's not a big challenge for most insurers to optimize the CO2, to reduce CO2. The flying is obviously a big issue for all of us, which is much harder and probably in the end has to be removed in one way or the other. Then there's the asset side, where I think we made a lot of progress. There's the Net Zero Asset Owner Alliance led by the UN, which a lot of people here, a lot of companies here are part of, which is more than $5 trillion of assets that have committed to their owners to be net zero 2050. And very attractive long-term shareholders who are attractive for any CEO out there, and therefore worth listening to. So there's a pressure being built on from the investor side, which is a new phenomenon in the last 2-3 years. I don't know any CEO who doesn't have a conversation around climate change with their investors. And before that, it was seen as a fear or an excuse for CEOs to say, yes, I understand climate change is happening, but my investors don't want me to do anything about it, or it's too expensive. This excuse is gone away. It's the contrary. There's actual pressure, as you can see, every day. So that makes me more optimistic. And obviously, there's asset managers amongst the audience here. There's a big burden here, the measurement and how do you do it. But I think we're relatively far advanced in terms of how to do it. And so the last challenge or bastion, I would say, is the underwriting side. So what's the carbon footprint of our own underwriting footprint? And that's very complicated. There's also an alliance that's been built to try to come to terms. It's a bit more complicated because there's more legal challenges in working together on something like that. There was an agreement by the chief risk officers on how to quantify some of these underwriting risks last year. But that's still for single risks. And as the risks go through the value chain, they end up in reinsurance. And when we do a reinsurance contract, we don't get the data, for example. So these are practical challenges we have today in terms of measurement and going down to net zero by 2050. There's still, I would say, 1 or 2 years of work to get the method right and get where we need to be. But at least I think it's moving. We can support the world also through assessment of risk, the asset side, the liability side. This is why I think on climate change, we're making good progress as an industry. Now, this issue has raised to enlarge it now. I think that one of the root causes that this issue has become so big is that nobody has a price for carbon. So we're not forced to pay for something we're using, so-called natural services. And that is not just true for carbon, but the larger issue, it's true for everything else, from natural resources, water, coral reef, mangrove forests, everywhere in the world. People do not have to pay for the value of the eco services they're using. And so you get into the much broader issue. If climate change is not big enough, that is related but not identical to the climate change issue of all these biodiversity and these ecosystem services. And I think we're very beginning, because even quantifying those services is difficult. And the Swiss Re Institute has tried that. There was a paper, I think this year, trying to quantify all these services. And of course, with all the flaws that is attached to trying to quantify them, trying to create indices, trying to correlate it to GDP. And certainly what they found is that more than 50% of the world GDP is dependent on such ecosystem services. But I think it's just the beginning in terms of what our action has to be and what our role in society is compared to vis-a-vis all of these broader issues is still in the flux. That's my view. Now, I just wanted to give one example of one transaction, not yet scalable, that we were involved in, which is interesting because it's concrete and includes a few aspects of what I just talked about. And it's actually a province of Mexico that asked us to do that. It's about the protection of the coral reef. If you have mangrove trees or coral reefs, they actually lower the physical impact of cyclones on the coast. And Mexico is dependent on tourism with all the hotels there. It's dependent on this coral reef. So the product we developed, which has different components, is basically a reinsurance against cyclones. But the payout will be fast because it's based on parametric triggers. So it's not, you don't wait too long. And then the payout is actually used for rebuilding the coral reef. So that means in advance, you train people of how to, there's ways you can restore coral reefs. It's a lot of work. And so you train people, and so that you know that when the money flows, they can actually go in and repair the coral reef, who then helps to mitigate the next hurricane. So you have a more holistic approach where the risk transfer is part of it, but part of it is also putting a price to the risk, and part of it is orchestrating all the different actors that you need to be prepared to know what you do once the money flows. So I give that example because I think it's interesting from different perspectives, but it's not yet scalable. I think there's a huge effort involved in that, and we're all exploring and so on. So I just put it here on the table, maybe for inspiration of something that could work. And I think that generally on this whole broader topic of biodiversity, ecosystem services, nature-based solutions, etc., is an area where we would profit a lot from working together as an industry. And certainly we would welcome, other ideas, collaborations across the industry, so that we can, fulfill the purpose we have in society. And I think the purpose will come through, or the mechanism through which we support, help, prevent things from happening, will be the putting a price on risk, which is, I think, always a strong incentive we put out there. The other one will be through actual risk transfer solutions, like the one I mentioned, something we do for a very long time. And the third one is as holders of assets. I think also here, I think we have a super important role to play. I can't remember how much of global assets are with insurance companies, but it's healthy. And if you add pension funds, I think it's actually a majority. So there's a lot of power that we have as insurance sector. And I think with that comes a lot of responsibility. And so with that, Jad and Mariam, I wish you a very good working group. I'm sure there's going to have a very interesting panel and speakers. I thank everyone for taking the time to join that, and wish you a very good meeting. Thank you very much.
Thank you very much, Christian. You obviously gave us a number of ideas for us to follow up in our discussions. So with that, we would like to move to panel 1, where we are going to look at some executive insights on these issues and how these are becoming a core business issue for insurers. As Christian and Jad mentioned, addressing climate change over the next few decades requires a well-planned whole-of-society approach to achieving net zero. And what this means is unprecedented transformation across all sectors of the economy. The society would be needed, and the society would be needed, affecting the way we live, the way we consume goods and services, and that are essential to our lives. In fact, according to the latest report of IPCC and IPBES, which was released last week, the interconnectedness of climate change and nature-based and environmental risks have been significantly stressed, and the fact that we need a more integrated approach to tackling these issues. Large-scale impacts of human activities starting to show its impact on the nature and related knock-on effects that go far beyond climate change, and these need to be further addressed. So among the critical issues that we love to discuss in this session is the need for transforming this dialogue that has traditionally been an environmental or social, corporate social responsibility dialogue into a core business dialogue. As Christian has mentioned, looking at materiality of these risks and how we can assess price and manage them. The need for more integrated and system-based approach to climate change and nature-based risks. Now, a lot has started to happen also, as Christian said, related to the sustainable finance framework to mobilize core finance into investing into these long-term problems. TCFD has really started us on the path to start thinking about climate risk, and hopefully with the launch of TNFD, we will start thinking about how to bring environment and nature-based risk into more of a risk conversation. Obviously, ESG approaches to investing and underwriting have been progressing and gaining a lot of momentum. And as again was mentioned by Christian, establishment of net zero and climate action alliances and the Glasgow Financial Alliance for Net Zero are among initiatives that's bringing industry and various sectors together to tackle these. Now, I would like to introduce our esteemed panel. We have Patrick Raflab, Group Chief Risk Officer of Swiss Re, Matt Saker, Group Chief Actuary of Aviva, Roland Umbrecht, Head of Global P&C Underwriting at Allianz, and Scott Hertz, Chief Investment Officer of Manulife Financial Corporation. Before we start our conversation, I would like to invite each of you for a 2-minute introductory perspectives. And I'd like to start with Patrick. So Patrick, in light of what we have already heard from Jad and Christian, the insurance industry certainly is mobilizing through net zero alliances and a whole range of other initiatives to address the ambitious net zero targets and play its role as risk managers, underwriters, and investors to help with the global transitioning to net zero. Can you elaborate, in your opinion, to what extent the whole concept of climate change, but going beyond to nature-based and environmental risk, has become important for companies at the board and C-suite level? And what are the critical issues we are facing today as an industry to build these issues into our core business?
Hi, Mariam. Thank you for having me. This is it's almost a too big a question for 2 minutes, but I try to just maybe focus on one particular aspect, which I think is important, that I don't want to downplay the importance of tackling climate change at the global level. I think it's necessary because of the enormous externality problem of climate change or greenhouse gases, because there really there is no limit to the externalities of greenhouse gases. I do think some of the environmental problems that we are addressing today have the advantage that they are more localized. And I see a big opportunity of insurance to use classic instruments of kind of pricing risk, and therefore also giving a value to the intactness of local ecosystems or local nature capital, to actually achieve sort of be almost more effective locally, or at least and we can scale that by sort of transferring ideas or concepts from one location or from one community to the other. And it clearly, experience shows that it's collective action is difficult anywhere, but it's easier in a sort of a smaller community than it is at a global scale. So that's really what gives me hope, and I think it's really entirely within the wheelhouse of the insurance industry. And maybe I stop there, and I hope we can have a further discussion about that.
Absolutely, thank you so much. With that, I'd like to move to Matt. Matt, at the heart of addressing these issues is our ability to be able to assess this risk and price it. So what do you see by way of challenges and opportunities for us as an industry for forward-looking risk modeling of nature-based risk as we move ahead?
Thanks, Miriam, and hello, everyone. It's a pleasure to be here today. Maybe I start with a quote that I heard recently. So, you cannot manage what you do not measure, and you cannot measure what you cannot value. I think that sort of summarizes it in a nutshell for me, really. So in other words, for an insurance company to be able to manage climate and nature-based risks, they really need to be able to value them, or more specifically, price them. So I think that's important. And I think it's essential that they do this. Otherwise, what we're going to see is insurers simply withdrawing from certain lines of business. And to be frank, we've seen that a little bit through the COVID-19 crisis, where certain companies were unexpectedly found themselves exposed to things like business interruption claims or travel claims that they hadn't intended. And their initial reaction to that has been, when the policy is renewed, to simply include exclusions. And I would argue that is a really bad thing for society, and it really goes against the core principle of insurance. So it's absolutely vital that as an industry we get on top of this and start to value these properly. So in terms of your question, Marianne, I really see three challenges here. The first, probably the easiest to get around, is to essentially identify the risks that that climate and nature-based risks introduce into our business models. So, you know, on the P&C side, that's things like increased natural hazards, natural catastrophes, for example, perhaps increased D&O liability claims. On the life side, it's probably an obvious one is the impact of pandemics. A very topical one would be the impact of pandemics. So I think that's relatively easy. It does start getting more challenging after that. So having identified the risks, you then need to start collecting data in order to quantify them. And I think that is a real challenge because the data or the amount of data out there is quite limited at the moment. And actually the data that we have is starting, because of the systemic nature of some of these risks, is actually it's contradicting previous data sources that we had. So it's a new paradigm almost. So that's a clear challenge. And to give you a couple of examples of that, on the life side, you know, the impact of pandemics, you know, everyone was aware of that risk. Some of the models were based on what we'd seen previously with the Spanish flu 100 years ago. But of course, Spanish flu largely impacted younger people and didn't so much impact older people because they had acquired immunity. Whereas what we've seen on COVID is the complete opposite. So actually the data points here are limited, and quite often, you know, there's a real flavour to them as well. On the PC side, obviously, the impact of climate and nature-based risks on cat risk is absolutely essential as well, that we model that. And, you know, we are expecting that to have an impact both on frequency, severity, clustering of cat events. So data is a real challenge. Once you've got the data, I guess the third challenge really is modelling the risks. And, you know, the obvious comment there is that it's extremely complicated. You know, the number of pathways we have here is immense. So modelling those sensibly is a challenge. There are huge interconnectedness and dependencies here. So, you know, the way that land is used has a huge impact on climate risk, but also has a huge impact on biodiversity and nature-based risks as well. So we need to understand those interactions, you know, the interactions between humans, animals, climate change, and the natural world. You know, we know that the other viruses, the next COVID-19 is in the wings somewhere, and we need to make sure we understand and can, you know, as best we can, price those risks into our policies. And then finally, I mean, again, complexity and timeframes is a key challenge. So, you know, these risks will emerge over a 20-30 year time period. We, you know, typically in the insurance sector, we're used to modelling risks over a 1 year period. That's what the regulations typically require. So that's another challenge. Just to finish off, I just would reiterate what Christian spoke about at the start. You know, what I've just spoken about is the challenges that the insurance sector has in pricing these risks, but there is a more macro issue, I think, around the value we place on natural assets, which is what Christian spoke about. So we need to recognise that, you know, every action we take, every time we drive a petrol car, every time we use a piece of non-reusable plastic, you know, that has a cost. Similarly, on the commercial side, you know, the actions of companies, there are costs associated to these. And other than sort of carbon credits, which is a reasonable example of where we've done that, we haven't really got to grips with that. And I think it's absolutely vital that we do, you know, and essentially develop a universally accepted framework for this, so that we can start working out the cost, allocating the cost, and once you've allocated the cost, you can then start incentivizing people, which is the key thing, incentivizing people, companies and governments to take action that will hopefully make things better. I'll stop there.
Superb. Thank you so much. You gave us a number of critical issues that we can dig into. Let me move to Roland. Roland, as the head of underwriting on P&C, obviously a lot of these topics are emerging topics for the industry. From an underwriting perspective, how do you see this impact as risk and opportunity for different lines of business, and retail versus commercial? What are you observing?
Thanks, Mariam, for the question, and actually thanks for having me. So I would have, as a starting point, I would like to say, just listening to Matt, Patrick, and Christian has just confirmed my decision 25 years ago or so to enter the insurance industry, that I'm actually in the right place. We come with this debate, we come full circle of what the nature of insurance should be about when it started insuring ships against loss in storms. So I do think that it is rather weird that the net zero points on tackling climate change are so far ahead in investment than they are in underwriting. So we have to do some catch up there, but I think it's coming full circle, and probably the general public is very right in reminding us as an industry that we do have a responsibility, and simply assuming that talking about risks with us, climate risk or environmental risk, they would be talking to the experts. I would have to say, on the broader definition of what you set out this panel, Mariam, beyond climate, I'm more on the receiving side. We'll want to listen to what Robert is also telling us, looking to the reports, because we clearly have more maturity on climate. Towards your question, so just a few observations. I think what we are seeing, and we're seeing it at pace, happening very, very quickly now, which is exciting, is we are moving from an understanding of NatCat to broader climate risk. Maybe sounds obvious, but it has certain implications, and certainly understanding the link to other nature-based risks would be important to that. But this broader understanding it's, for example, it's involving triggers, it's involving scenarios, it's involving losers and winners. It's really an emerging picture that is bigger than what our traditional NatCat picture was. Specifically, I would say transition risks enter the picture, and it's not just insuring property. So what comes to the fore is, and here I'd like to thank and congratulate the Geneva Association also on one of your latest papers, climate change litigation. So it's also entering the litigation and the liability space. So even the physical risk is, to your LOB or line of business question, moving far beyond property. Content-wise, I think what we're seeing is in commercial, so from the first and very traditional things of unfriending coal or getting your hands off tar sands, we move to insuring and helping clients transition, for adding adversary or risk management services. On pricing, I think Matt has hit the nail on its head. Maybe I can come back later in the discussion to that. What I would say though is that we do have, also being a retail insurer, as Allianz also is, I think we have to look at the topics with the whole insurance value chain. And one of the most essential services that we provide is a claims service, claims handling, claims settlement service. And there I would actually see quite some win-win-win situations where we can help our clients. It is not, it would help the footprint and the planet as well, and it will not be at the expense of shareholders only, still be a very viable business model. Maybe we come to that later again. And I'm excited that Patrick singled out the very traditional methods of insurance as well. So geozoning or having a look at local effects entering into pricing and underwriting is obviously something where we can, as an industry, have an impact.
Excellent. Thank you so much. A number of foods for thoughts is coming, which we will extend in the discussions. Now let's move to the other side of the balance sheet and invite Scott. Scott, clearly many have mentioned already investments from both sides, investments that the industry is making on one hand, but also how investors in insurance industry is looking at, insurers and the sort of in a way, like encouraging that they need to be think about, these issues on both sides of the balance sheet. So maybe you can share with us, how are these issues being incorporated in the investment strategies and approaches today? And what are some of the key drivers of your investment decisions today linked to these topics?
Yeah, thank you, Miriam, and thank you for inviting me on this panel. It is something we spend a lot of time thinking about. You know, as a life insurance company, our liabilities are very long-term, 20, 30, 40, 50 years out. So investing to back those liabilities, we need to be looking out to those sort of time horizons. And, you know, most of our portfolio is investment grade fixed income. And so when we lend to companies, we need to be thinking, are they going to be sustainable for those lengths of time? So sustainability has always been a big part of what we do, given the nature of our liabilities and hence our assets. And as we think about sustainability, it's hard to look out 20 and 30 years, and climate change and environmental risks have become a bigger part of our thinking for sure, because it's maybe become a little more evident that climate change, you know, is having an impact in the short run, but there's just no question that over the time frame we're looking at, climate change, you know, could have a very big impact. So when we think about those risks and our investing, you know, beyond sort of the societal responsibility that we firmly believe we have, we think it's just good, you know, as a fiduciary, you know, taking care of our clients, we need to be really attuned to these risks. So, you know, if you look at our portfolio, our fixed income portfolio, it is, as I said, very long. On average, it's about 20-year in duration, but we will lend out 30, 40, and 50 years. And historically, we've been, as an example, overweight to the utility sector. It's an essential service, it's a regulated industry, it seems like a safer place to be. And as it turns out, it's one of the heavier emitters of greenhouse gases. But that doesn't mean that we necessarily de-emphasize that sector. So the main point I want to make is it's a little less about the starting point and what these companies' profiles are, but more where they're going. And as we evaluate investments from a bottom-up perspective, we want to make sure that management is attuned at these companies to where the world is going, and that they have plans to decarbonize, the incredible plans. And I would say, you know, in the utility sector, it's probably one of the easiest areas to decarbonize. You know, coal plants are being retired, renewables are coming in. And so we'll continue to have a large investment in that space, but we will, you know, we will look to invest with those companies that are making the necessary changes and avoid the ones that aren't. So really, and that's true for every loan we make, we're evaluating what their long-term plans are, that they're paying attention to this. There's also a top-down aspect to strategy as well, though, as we more broadly think about what the world will look like in 20 and 30 years. And as I said, it doesn't necessarily mean you avoid certain sectors, but you certainly will want to de-emphasize, like oil and gas. Clearly, there's still a need for it, but it's a declining industry. It's in a secular decline, and you need to be cognizant of that. Probably the part of the portfolio beyond investment grade fixed income, we do invest about 10% of our portfolio in real assets. We own real estate, we own infrastructure, we own timber, we own agriculture. And that's an area where, you know, there's maybe more offensive investments as well, investments we can make that can help with the transition. And, you know, you mentioned beyond climate, biodiversity, and more broadly nature loss. For sure, that's very top of mind when we're making real asset investments, either those investments that are taking away from nature, you're developing a real estate project somewhere, that's an important consideration. And certainly it's very important in agriculture. Biodiversity is critical to the functioning of that. We're using a lot of acres. So, you know, I can talk more about that as we get into the session, but that's an area in the portfolio where we certainly can have an impact going forward.
Excellent. Thank you so much. And to the audience, please feel free to submit your question in Q&A or raise your hands. But I'd like to sort of go with one round of questions before we move to some of the questions posed by the participants. And I want to come back to you, Patrick. You talked about very pragmatically about some of the local solutions that the industry can take already to tackle some of the environmental and nature-based risk. And Christian was talking about some of the work that you've done for protection of coral reefs. I want to sort of expand this on two fronts, particularly focusing on this whole issue that this is not a local problem anymore. It's truly, you know, the impact of human behavior on nature when we look at deforestation, the scale of loss of mangroves and so on, is starting to resonate in our life in sort of a larger scale way. So I have a two-part question for you. On the first part, pertaining to some of the local solutions for protection of nature-based, if you can expand a little bit on that as to where the industry is and where the opportunities are. But the broader question is, as we look into the future, can the industry play a role to impact societal behaviors, business models, development sort of patterns that are leading, that are the ultimate cause of these kind of risks? Where do you see the position of industry in that regards?
Yeah, so thank you. Of course, the problems tend to be global in nature, and a lot of behaviors that are small have far-reaching consequences. But at the same time, I do think we should not use this as an excuse for not acting locally. So action actually takes place locally. So, and to answer your question specifically, the industry, or at least as far as we are concerned, we're not very far. So the example that Christian has quoted is one of the few. And there is also this is a public entity, so it's not a private owner. So we are not yet in the situation where we have a widespread understanding of private ownership of natural assets with an eye on the positive externalities of those assets. So this is still a collective good, but it's easier to organize locally, right? And that was my point, and that's where we are. We are not very far, but it gives me hope, because in principle this is scalable. It doesn't require global coordination. It just needs, following an example. And it is very basic. It's basic stuff we have been doing. It's evaluating risks, and it's evaluating relative cost of mitigation. So is it more expensive to carry the risk and rebuild if something goes wrong, or is it actually more beneficial to prevent, right? And then you start having an interest in funding the prevention, right? Because you avoid a loss, and the loss tends to be a private loss. So that was really the sort of conceptually where I was trying to go with my argument. And I do think that because of this sense of urgency, I think it makes a lot of sense to really use established tools and try to combine them in a way, rather than so move as quickly as possible from the very lofty sort of global theories to actually concrete small steps that improve the situation. Yeah, so that was really where I think we are in this phase where we can do it, but yes, we now have to scale.
Excellent. I think that's a very big message, because everybody says that it's all about coordination and multi-stakeholder engagements, where you're saying, no, let's not wait. There's a lot that we can do today, and we can start with that impact. Matt, let me come back to you. You definitely laid out the challenges with sort of starting with the data and then modeling and pricing of these risks. Let me shift gear into the regulatory perspectives. As we all see that the financial services regulators have put a lot more attention into climate risk assessment, forward-looking climate risk assessment, to try to understand impact of these risks on the financial sector and insurance sector. And already there is a lot of challenge with that. And now we are starting to see movement with, for example, ACPR or other regulatory bodies starting to look at nature-based risks. What has been the experience of the industry so far in terms of working with regulatory bodies in these areas, and where do you see an opportunity for the industry to really join force with regulators to undo these uncharted waters? These are very difficult problems to solve. Where do you see that engagement to bring benefit for moving us forward into this area?
Yeah, it's a really good question. So, I mean, as we all know, no individual or company or individual government can solve this on their own. But collectively, we can hopefully make a difference and do enough to change the position. So that the key word for me here is absolutely collaboration. So, I think we've made some good progress in the last 2 or 3 years with the regulator. But my sense is actually, we're talking here about environmental nature risks. It feels like where the industry, where regulators, governments are on nature-based risk is similar to where they were on climate a few years ago. So there's definitely some catching up to be done. What we need to avoid, absolutely, is a scenario which, to be honest, we sometimes get ourselves in, where the regulators send out massive data requests to us as industry. We spend a huge amount of time collating data. By the time we send it back, it's out of date, and the regulator doesn't really use it. That's not a productive use of anyone's time. So we do need to work together with regulators. And I do see regulators having a key role in facilitating the process here. So what does that look like? I mean, in the UK, you mentioned ACPR, but in the UK, the PRA have issued a supervisory statement a couple of years ago, which required all financial service companies to integrate climate risk into their risk management frameworks. Having done that, insurers certainly realised pretty quickly that, the implications of this are that a lot of these risks will just become too expensive to insure if we're not careful. And you get back to the old mantra that, an unsustainable world is an uninsurable world. So that leads to the question, what do you do about it? Aviva, along with a load of other insurance companies, have signed up to be net zero. For us, it's by 2040. Underwriting is a little bit behind, but again, companies are signing up to the net zero underwriting alliance as well, and starting to stop underwriting certain industries or certain industries such as coal, if companies are getting too high a percentage of their revenues from those sources. The rubber hits the ground really with metrics. So again, Aviva, like others, have started to introduce metrics to really hold ourselves to account, if you like. So things like carbon intensity, green assets. New metrics are coming in, like portfolio warming measures, which Aviva are using quite extensively. This is all in our TCFD disclosure, and we're very supportive of the TNFD initiative as well. And of course, then you need to build that into your remuneration structure to make sure that there's actually some bite to it, as I say, around holding people to account. The final thing I would say on regulation is an interesting area from my perspective, is around modelling and around capital. So the extent to which you start to build in an allowance for some of these risks into your capital calculations. And that is an interesting area because it's not obvious how you would do that, but there is a huge opportunity there to potentially create the right incentives for organisations such as insurance companies and banks to take the right action. So if, for example, you have to hold less capital if your if your assets are greener or you're underwriting the right risks, then that reduces your cost of capital, incentivizes you to do more of that. So that is certainly a very important area that needs to be explored with regulators.
Thank you so much. I want to turn to some of the questions that are being posed by the audience. And Roland, there is a question, maybe actually I'm going to try to combine two questions related to the underwriting side. One of our audience, Sophie Laurie, has said that I very much support the idea of need for local approaches, as was suggested by Patrick. And she says the challenge then is to how to promote and scale these ideas and make them contextually relevant to the others. So from your perspective, as you look ahead, in terms of both risks and opportunities from an underwriting side, what are your views for current tools that we have that we may be able to use locally, and how can that be scaled up?
Okay, let me try to answer that. So first, I would like to say that there are probably two trends or two topics that make it much more easier to act. So I would agree with Patrick. Whenever there is strong local effects, we come in with the traditional things, and even a traditional cost benefit would help with prevention. But the question from the audience comes in, it's more difficult when we don't see those things happening. That's maybe a bridge to Matt's comment on the capital side. Public pressure, and you mentioned regulatory ones, but there are NGO and science-based ones and just reputational issues will turn these topics into a competitive advantage by actually providing us with lower capital costs and make it beneficial also in analogy to internalizing local external effects. We will have a natural business interest to lower our capital costs and moving on those topics. Those things, we see big momentum with more catastrophic events with local exposures. So the tool question would be our traditional insurance tools of risk assessment, risk mitigation, pricing and underwriting, exclusions, limits, accumulation controls, scenarios, the usual stuff. The other would be building competitive advantage by having greener portfolios and answering more to society. The third one would be, I still see a big need for concerted and coordinated action. And there we see big movements now, also ahead of not just of impending disaster and catastrophe, but also, for example, events. You mentioned at the outset the GFANs or COP26 coming up. These are catalysts. Even the G7 in Venice on the 11th of July, those events are catalysts where public opinion, science feeding into politics can help to create the momentum. As industry, I would say we would then have to jump on that and live up to that, and it would concerted action, for example, also the mentioned UN convened net zero alliances. There are by now several and more in the making, would help us to be more consolidated and more concerted around that. The tools that are missing are the ones also mentioned from Matt, from you, Marianne. We need more work on the metrics and on the data. One is Christian in his intro said it will take us about 1 to 2 years to come up industry-wide probably with good metrics, how to come up with our net zero commitments as an industry. I would add to that potentially we will need to be very flexible as the science is changing. So I think the competitive advantage will help us all as companies to adapt faster. Public pressure will feed into that. And if we would combine our passion for the environment and for the planet with hopefully an insurer's natural passion about data, that this would help us move quicker. I mean, we're the industry that invented the profession of the actuary. We should be excited to have the opportunity to come up with metrics and new sources of data that help our stakeholders, all of them.
Super, thank you so much for that. Scott, there is a question from the audience about the fact that the industry drives its profit from its investments, and with consideration for these issues of climate change, emerging nature-based risks, and so on, and given the traditional fiduciary responsibility on return on investment, where do you see concrete shift in terms of approaches of a company from an investment side, insurance company from an investment side, to really take these issues into account? Do you see requirements? How do you see, what are some of your challenges and what are the opportunities to help you really achieve good investment strategies in light of so many uncertainties and new emerging considerations that are that's on you as a chief investment officer and responsible for investing the funds?
Yeah, thank you for the question. And you know, first of all, I'd say profits from an insurance company, you know, come from the whole package, the underwriting, the selling of products, and the investing as well. It's not just from one side or another, but it is clearly important for us to be able to price competitive products and provide a decent rate of return, that we need to do a good job in our investing. And we can't be just trying to do the right thing for society without an eye towards what does it do to our investment return. But I would say by and large, they're very aligned. As I spoke to earlier, that we are concerned about risks, not in the next quarter or the next year, but risks that will emerge over a long period of time. And so I think there's very much alignment between creating a sustainable, good, attractive investment return and, you know, doing the right thing for society. There are, of course, challenges to that. I think, you know, Matt mentioned one with the amount of capital we need to hold. Regulatory capital is an important consideration in our investing. We, you know, our shareholders look for a good return on capital. And, you know, regulatory capital regimes are very blunt tools. It doesn't even need to go as far as sort of reducing capital requirements for green investments, although that would not be a bad idea to achieve sort of policy goals. But the example I would give is we've been a big investor in renewable energy for a long time, and a lot of capital has flown into that space and a lot more needs to. And, you know, returns have come down, and it's become a very well-established space and a very safe space to invest. And yet the capital requirements against that kind of investment are the same as if we were making a venture capital investment, and higher than if we buy public equity. So that doesn't really make much sense. We're not slaves to regulatory capital. You know, we still will, I would say those investments do not provide a good return on regulatory capital. We still make them, but we would flow a lot more capital into that space if those capital requirements would come down. So that's one place certainly where we could look for some help.
Super, thank you so much. So we are starting to move towards wrap up, but we're not still wrapping up. I want to combine a couple of questions from the audience before our, your 1 minute wrap up. So the very first one is around life underwriting, and anyone that would like to take this, probably Matt, it might be something that you might be interested. And the idea is, we talk a lot about P&C, we talk about investments, we talk about risk, and generally we don't talk about how these, particularly when we talk about nature-based risk, climate change implications on life, over long-term horizons. How do we integrate these risks into the life insurance business? And, if any of you would be comfortable to point on that a little bit, attention on the life insurance side. Matt, would you like to take that on?
Yeah, I'm happy to do that. It's, life risk is a long-term risk, stating the obvious. I mentioned the challenges we have had modeling pandemics earlier, and the difference between COVID-19 and the Spanish flu. They were almost diametrically opposite in terms of the populations they impacted. I think the good news here is that none of this is new. As risk professionals, as actuaries, we've been dealing with this uncertainty forever. If you go back to the late 1980s when HIV/AIDS emerged, no one knew how that was going to play out. But what you didn't see is the insurance industry withdrawing from cover altogether. They got stuck in, they priced those risks as best they could, and cover continued, and that whole thing played out, which I think sort of brings home the whole importance of expert judgment here. Because of the uncertainty of these risks, we're never going to have certainty in the data. So the importance of applying expert judgments here is really key. I did mention, understanding the interconnectedness of all these risks. As an actuary, I'm very interested in in those interactions, in the diversification benefits you get between these different risks, and how you manage your whole portfolio in a consolidated way to make sure that your overall risk is balanced is quite important here. And that's something that applies generally, but it's certainly something that applies to the risks we're talking about here.
Super, thank you so much. So we want to wrap up the session, and as we start moving towards the transition to a net zero, we will hopefully, technological developments are going to help with disruption of economic sectors, but obviously they're going to have, presumably a lot of environmental and other related risks that we haven't anticipated. Now, position yourself in a conversation together 5 or 10 years from now. How have the world changed? How have the insurance industry responded to it? And what are the 1 or 2 things you envision today we must do to get there? And I'd like to start with Patrick. What does future entails, and what should we do about it that we cannot compromise? We have to move that way. Over to you, Patrick.
Yeah, thank you. So I do think in 10 years, the negative emissions technology will be the size of, or get towards the size of today's oil and gas industry. And I do think that as an insurance industry, we have to be willing to apply our tools, our technologies, traditional technologies, but also to take a bit more entrepreneurial risk in that industry than we are probably used to, because and we should avoid, obviously, to make this an excuse for not reducing emission, because that's a risk. But I think even with a best effort or a really successful effort, we will also need to sort of the world will need to have enough sort of negative emissions, whether it's nature-based or technology-based. And I do think this is going to be an opportunity that right now we are probably still not seeing the full extent.
Thank you so much. Matt, your thoughts?
Yeah, my hope with all this is that I really see the insurance industry having such a key role to play here. But I do think there's 2 ways it can go. We could either have the carrot or the stick. And if you think of the stick approach, in simple terms, I've mentioned it a couple of times already, but if we would withdraw cover, if we were to withdraw cover collectively, I know there are antitrust issues with that, but if we were to draw cover for D&O for certain types of risks, then that would certainly drive behaviours, right, and would drive potentially quite a rapid change. I think we should always reserve that possibility, but I really hope that the industry goes with the carrot approach and actually, incentivizes people, individuals, companies to change their behaviour voluntarily. And we can't do that on our own. As I said before, we need to work collaboratively with governments and regulators. But that is genuinely my hope, that we end up with a carrot rather than a stick.
Thank you so much. Roland, how is our underwriting different 5-10 years from now than today? How has it evolved, shall we say?
Okay. I think we will have much more data and be much more aligned with bringing metrics into our core underwriting, risk assessment, and pricing practices that are very much in line with the 1.5 degree scenario. So we will see an alignment of climate science and the traditional insurance methods. I would also hope that as an industry, we are seen as leaders, and we are seen as, in 10 years from now, not having shied away from the challenge, but having actually stood up to it. Whether that's the carrot or the stick, let's see what it will be. But as we speak, the ESG board of the Allianz Supervisory Board is having a meeting. So I think we will see carrots and sticks over the next 10 years, and hopefully will emerge as being societally relevant to help our clients. And I'm pretty confident and still excited to be part of that industry. Don't want to be seen as laggards in that discussion.
Excellent. Thank you so much. And Scott, over to you. And on the investment side, do you see major shifts in the way insurers are investing, particularly the long-term insurers?
Yeah, a couple of thoughts on that. One is that I think, as an industry, we need to be focused on making sure the companies we invest in are headed down the right path, so that we're all collectively driving to net zero. And I think that will happen. There's this huge momentum behind it. But to get to net zero, to build on some of Patrick's comments, we will need ways of sequestering or capturing carbon. And I think that will come. It's very expensive right now. But I do think, the nature-based solutions that we have now can be very helpful. Timber investing, even just normal sustainable timber investing where you harvest, typically you do put a lot of the carbon into lumber products where it doesn't emerge for a long time. But if we get carbon priced right, and one of the panelists talked about pricing externalities, which would be the best way to go. And we do see carbon taxes, but the US, there's not much there. Although I think one thing we're seeing emerging is companies themselves putting their own internal price on carbon, which is a good thing. And you will start to see, and we've started to do this, we've started to migrate some of our forests to, we're not harvesting anymore, we're just going to let them grow. And it becomes economically feasible if you put, and not even a very high price on carbon. So I do think that's part of the solution, and you'll see more of that going forward.
Thank you very much, gentlemen. Excellent conversation, a lot of food for thought, and certainly we very much embrace your recommendation of collective action along with local solutions. So thank you very much for this great session. And I want to thank you all and wish you a great rest of your day. Now we would like to move to our next segment, which would be the keynote speech. Thank you very much, Roland. Wonderful. So it's my pleasure to invite Sir Robert Watson to deliver the keynote presentation on challenges of addressing climate change and nature. Bob Watson does not need an introduction. He's one of the most influential environmental scientist worldwide, contributing to multiple assessments of sciences to inform international and national policies and actions. Bob is the former chair of IPCC and former chair of IPBES. He's the author of the recent UN report, Making Peace with Nature, a scientific blueprint to tackle the climate, biodiversity, and pollution emergency. Bob, welcome. It's absolutely a pleasure to have you, and the floor is yours.
Thank you very much, both for the invitation. And let me say, I found the first panel and the previous speakers extremely interesting. So this has been a very good morning so far. If I could have the first slide, please. I'm going to show a series of slides. I don't know if anyone can see it at that size, but is it full screen? Because it looks very small to me. Okay. The key issue basically is we humans have been transforming nature, and we are now putting our future at risk. We've seen a significant growth in the economy and a significant growth in trade, and human population has increased significantly. All of these things have led to major development in many parts of the world, far less poverty today, far less hunger than we previously had. But we still have 1.3 billion people that are poor. We still have over 700 million people that are hungry. We're seeing that greenhouse gas emissions have increased. We're seeing our land has been degraded. And so fundamentally, we are risking with the current development model, livelihoods, equity, health, our economic development, and peace and conflict, basically. So we need effectively to transform our relationship with nature. We're more one with nature rather than fighting against nature. The next slide shows effectively how all of these environmental emergencies are intertwined. Climate change is affected by land degradation and biodiversity loss. In turn, land degradation is affected by climate and biodiversity loss is affected by climate and land degradation. And all of these affect and reduce human well-being. The Earth has already warmed more than 1 degree Celsius. Biodiversity is being lost at an unprecedented rate. 1 million of the 8 million species on Earth, animals and plants, are at risk of extinction. These emergencies must be dealt with together in concert with the development challenges of food security, water security, good health for all. We need our international environmental agreements to be aligned with the trade agreements and the development agreements, and all actors have a role to play, especially, in my opinion, governments and the financial sectors. And indeed, the recent G7 communique recognized the importance of addressing these issues together. The next slide shows effectively where are we on greenhouse gas emissions and climate change. There's no question, if we want to reach the 1.5 degrees Celsius target of the Paris Agreement, we need to reduce current emissions globally by 45 to 50% by 2030, reach net zero by 2050. If we want to reach a 2 degree target, we would have to reduce our emissions 25% by 2030 and reach net zero around 2070. However, our current pledges put us on a pathway to 3 to 4 degrees Celsius. The graph on the right-hand side, and you don't have to look at the detail, current pledges would suggest that emissions in 2030 will be the same as they are today, not reduced. Hence, we're on a pathway to 3 to 4. And therefore, the insurance company needs to look at the risks, not just of a 1.5 and 2 degree world, but a 3 to 4 degree world. And the key issue is not net zero emissions by mid-century. It's taken the eye off the ball. We need to reduce emissions now. Everyone keeps talking about net zero. They should be talking about how do we decarbonize between now and 2030. Net zero has become a dangerous buzzword. The next slide, please, shows that if we want to deal with nature, we have to have a very holistic approach. First, we need to conserve it and restore it. And restoring it is actually good economic value. It leads to increased livelihoods. It's good for biodiversity and it's good for climate change. But then we need to address all of the drivers of biodiversity loss, changing land and sea use, overexploitation, especially in the marine environment, climate change, pollution, invasive alien species. Now, while climate change has not been the dominant driver of biodiversity loss today, it's probably the third most important. If we don't reach the Paris targets, and I don't believe we will, I really don't, and I have no faith like Patrick in these so-called negative emission technologies, and nor do a lot of people, then effectively climate change could be the biggest driver of the loss of nature and biodiversity. And lastly, we need sustainable production and reduced consumption. The next slide says we need to transform our economic, financial, and productive systems. And if we do, it can lead and power the shift to sustainability. We need to include natural capital in decision making. We need to use inclusive wealth, not just GDP, to evaluate our economic growth. GDP does not allow for the loss of natural capital, and it doesn't measure sustainable economic growth. Eliminate environmental harmful subsidies in agriculture, fossil fuels, transportation, mining. We need to internalize externalities to get the price of goods and services right, embrace a circular economy, and invest in a transition to a sustainable future. We can no longer think of food, water, and energy systems as separate systems. You can't think of agriculture without thinking about water and energy, and vice versa. And therefore, we have to transform these sectors, but we have to transform together, not individually. We clearly need to ramp up investment in sustainable activities, and some of that money can come from the elimination of some of these perverse, harmful subsidies. The next slide starts to talk about the finance sector. Well, first, there's no question that governments have to lead by transforming the economic and financing sector. They have to lead in the transition to a low carbon economy. They have to lead in a transition to both conserve and to restore biodiversity through regulations, legislations, policies, and investments. But the finance sector has an incredibly and strong role. It needs to disclose financial risk for both climate and the use of natural resources. It needs to move to net zero, but as I've said, the real issue is the immediate decarbonisation of your portfolios. One needs to increase the share of climate finance, possibly to 50%, for climate adaptation and resilience, such as early warning system, climate resilient infrastructure and agriculture. Develop innovative financing mechanisms for conservation and restoration of biodiversity, potentially get involved in protected areas, especially in the oceans, which will actually in the long term be good for sustainable fisheries. Support One Health. The current pandemic shows how we have to look at nature, human health, both plants and animals together as one interrelated system. And especially we need help in all sorts of ways in developing countries. And my last slide talks about the finance system in the transformation of the economic, financial, and productive systems. I've already really said it. You can play a key role in promoting and using natural capital accounting and inclusive wealth, built capital, human capital, natural capital, all in the context of social capital. Promote the internalization of externalities into the price of goods and services and a circular economy. It helps to eliminate harmful subsidies, facilitate carbon trading schemes for offsetting nature, payment for ecosystem services, facilitate your investments, which you've talked about this morning, away from unsustainable activities towards a more sustainable environment. We need a transition to a circular green and low carbon economy. You can play a really key role in this. No question, we need to change our agricultural system. We need sustainable intensification, ecological processes, agroecological processes, and that can really make the agricultural sector help on climate change and biodiversity, not be the major enemy of biodiversity and climate change. And clearly, and you've mentioned it already, finance low carbon energy production and use. I think that's really what I would like to say to stimulate some thinking.
Thank you so much, Bob. Obviously, there is so much, and packing it into a 12-minute presentation is very challenging, and grateful that you brought all these messages in this tight schedule. But you've raised the attention to a lot of fundamental points. You pointed that net zero may be a cliche. We need to move towards lowering carbon today. The next 7 or 8 years is foundational in terms of us trying to achieve these issues. You also pointed to the need for governments to taking a lead role. And I want to first go there, because obviously there is significant movement by way of sustainable finance initiatives. What the financial sector is doing to restructuring itself to be able to invest at scale, financial and insurance regulators are on it. The main issue becomes governments, from my perspective, and the economic sectors, the carbon intensive sectors, or those sectors that are harming nature and subsequently, resulting based on their practices. How can we break that code of getting governments to take the lead role that they should play? Can't we learn from what happened with COVID?
I actually think that very few governments in the world have dealt with COVID well. I think it's an unmitigated disaster, personally. The UK is built on science. It's got one of the worst death rates per capita in the world. The US is no better. Most of Europe, with really good science, has been a real problem. They're as bad or worse than Brazil, India, and other countries. So I actually don't look at COVID being a true success story, with the exception of the development of the vaccines. And I think the scientists that developed the vaccines have done a good job. And I believe the UK, amongst others, has done a good job in bringing vaccines into the public. But the way the pandemic was dealt with, in my opinion, was not a major success story. We're now seeing third and fourth waves in many parts of the world, including Australia. In Sydney, only yesterday it was released. No, we need governments to have strong commitment to international action. We need to commit to the Paris targets, even though I don't think we can get there, but we can get close to them. We need governments to reform the economic system, but most important, they need to work with business. They need to work with the financial sector to jointly come up with the policies and the regulations. We need a government and finance and business to work together with civil society. It does take collective collaboration, not individual. So yes, we need to get the pricing right. I think governments can lead the charge on getting rid of these perverse subsidies. They can lead the charge on using green accounting. All of these things will go in the right direction. And let me be clear on the net zero. We need net zero emissions by the middle of the century, but everyone keeps focusing on them rather than focusing on emissions reduction, all hoping on these negative emission technology that Patrick seems to have confidence in. But to be quite honest, many of us don't have confidence. They're unknown technologies. Why risk the future on unknown technologies when we know what we need to do today? Large-scale reforestation will have real problems, in our opinion, on water and biodiversity. Large-scale bioenergy with carbon capture and storage could also be very adverse if it's monoculture on biodiversity, food and water security. So we have to say, what can we do today? Not just rely on these technologies, but we do need to do research on negative emission technologies, but we should not be relying on them.
Thank you very much for that. And let me invite Oliver Shelsky, who has raised his hand, if you'd like to pose a question to Bob. Oliver?
Hi, Bob. Yeah, thanks, Mariam, for giving the voice. So my name is Oliver Schelski, and I'm representing Swiss Re Institute in charge for biodiversity research here. So many thanks, Bob, for the intriguing presentation, which I think on one hand is alarming. It shows the alarming situation we are in, but it's also very encouraging because you have presented a long and concrete list of suggestions for action for the financial sector to be taken. So let's work on that. And I have to say the panelists early on have pointed it out, and maybe we'll work on Patrick. So I think the industry has been, especially from the investment side, on a strong decarbonization track for years. And mentioning the carbon removal technologies, that's one side. And the Swiss Re position clearly is that's not the only thing we can do. So we have to do all these things simultaneously. Decarbon the underwriting, decarbon the investments, but also look at these new kinds of technologies that are there in order to do carbon removal, but also at the same time look at the impacts that may be on nature. But maybe to my question, so looking at the to-dos to restore, improve nature and combat climate, if you look at the world as of today and into the next 10 years with your multi-decade experience in research, in policy shaping, let's say, for the transformative change that is needed, in your words, what would be the two biggest hurdles to overcome, apart from governments and businesses working together? And if you would call yourself an optimist or a pessimist, if you look at these two biggest hurdles?
I'm optimistic in the sense that both government and the private sector are all moving in the right direction. The rhetoric is correct. The World Economic Forum in the last 2 years, as you know, have looked at the biggest risks to their sustainability. And 2 years ago, it was 5 environmental issues. This year, it was 4 environmental issues and pandemics. So the recognition of the problem by both governments and by industry that these are interrelated issues, which are not just environmental issues, but they're economic, development, security, social, moral, and ethical, is a major step in the right direction. So I'm optimistic we've got the rhetoric right. However, what I don't see on paper is the actions to meet the targets and the goals of either many of the governments or the private sector. To me, and I'm not an economist, I'm a natural scientist, I think if we can get the economics right and the financing right, we really have a fighting chance. And so I am pessimistic that we will not reach the 1.5 or 2 degree target. I am optimistic we can keep it close to 2 degrees Celsius if we act now. And if we act now to get right policies in place, I think we can start to conserve and restore biodiversity. But to be honest, the world failed to meet the 20 Aichi targets to protect biodiversity. None of the 20 were met between 2010 and 2020. So we have to understand, why did we fail to meet the biodiversity targets? What can we do different in the future that will lead to success? So we need a much better analysis of why we've been failing. And we have to recognize there are some powerful vested interests who want the status quo. They love these perverse subsidies. They love cheap fossil fuel. They like exploiting nature for short-term gain. So we have to address the vested interest through regulations and incentives, not just regulate, but also incentives.
Thank you very much. And a great note to finish on. Bob, first of all, thank you very much for years of great contribution to this field. And I know that you will continue your quest for many more years to come. So with that, we want to thank you for very thought-provoking ideas, I think quite sobering, and hopefully something that participants and the industry will take forward in its thinking as it innovates and works towards this issue. With that, I want to thank you for taking the time to join us in this session, and really appreciate your participation. So we will now...
I hope Patrick is right and I'm wrong about negative emission technologies. Thank you very much. Bye-bye.
Thank you so much. Great to have you. Bye-bye. Thank you. So I think we had scheduled a 5-minute coffee break. What I like to suggest is we will just take 2 minutes for a quick break, and we will come back to a very exciting panel that will be moderated by Martin Wayman, looking ahead to drivers and impacts of environmental and nature-based risks and role of finance and insurance as we look ahead. So 2 minutes break, we should be back by 3:31 Central European time, 9:31 Eastern time to continue. Thank you. Thank you, everybody. Even though it was a short coffee break, I hope you had a chance to at least stand up and stretch. But now, with no further delay, we would like to move to the second panel of today. The topic of it is looking ahead. How can insurers address the drivers and impacts of environmental nature-based risk? It is my pleasure to introduce Martin Wayman, Head of Sustainability, Emerging and Political Risk Management at Swiss Re, who will be moderating the session and introduce the panelists. Martin, over to you.
Thank you very much, Mariam. I think we have a fantastic event so far. So we have heard about the business perspectives. We have just heard from Sir Bob Watson about the state of the environment. We have heard we have on climate change already 1 degree more than we had in pre-industrial levels. We know about the steep biodiversity and ecosystem services decline, which affects 55% of the world's GDP. And at the same time, also the awareness is rising very fast on further topics, or as the conference is called, the emerging environmental topics, which are beyond climate change. And I think that's exactly the panel, the goal of this panel, to exchange with a very distinguished list of panelists here what can be done very concretely to take a bit the temperature feeling where we are on those different topics and what can we do. So we could talk about a whole big set of environmental topics, from resource scarcity. We heard about food and water supply and the interconnections to climate. Plastics, microplastics is a big topic. Environmental pollution, antimicrobial resistance to pandemics. But I think a very important one that definitely emerged is the two things when we look at on one hand climate change and on the other hand biodiversity and ecosystem services. In that sense, I want to very quickly introduce my panelists. I have the pleasure to have an enormous, powerful group here from both business, NGO perspective, from also the rating agencies perspective, and 2 business representatives. We have Claire O'Neill, the Managing Director of Climate and Energy from the World Business Council on Sustainable Development. Welcome, Claire. It's great to have you.
Thanks, Martin.
We have Mary Diron, the Managing Director of Moody's Insurance Service. Welcome, Mary.
Thank you. My pleasure to be here.
We have Margaret Kulov, Global Finance Practice Leader of WWF and the founding partner of the Task Force on Nature-Based Financial Disclosure. Welcome, Margaret.
Thank you, Martin.
We have Chip Conliffe, the Director of Biodiversity from AXA XL and co-chair of the Ocean Risk and Resilience Alliance. It's great to have you and to hear how those things are applied in business at AXA. Welcome, Chip.
Martin.
And we have Michelle Lacroix, who is super engaged on many fronts on sustainability as the head of Group Investment Risk and Sustainability. So just continuing on the discussion that we had before, I think I'm really interested from all panelists to hear much more detail now on what can be done. Where do we stay now? What can be done, and what actions do you think the insurance industry should take, and how should it collaborate with the real economy, but also with other players in the financial sector, as well as with governments. And I would like to invite every panelist to come with a probably about 2 minutes introduction, and we'll frame it with a couple of questions. First of all, I would like to invite Claire O'Neill from the World Business Council to just explain a bit on among the companies that are engaged in the World Business Council, where many real economy companies are participating. How is the those economic sectors, how do you see the integration of what we just heard from Watson of those different topics happening? How do you see that externalities are taken into the business models of today with regard to nature-based risks? And what is the current state of thinking, and it is going far enough? Then also just outlining what do you see as the current risks and opportunities? I know this is a very broad question.
Yes, that's a very long question. Hello, Martin. I don't want to take up the entire panel with the answer, so I'll try and answer some of those points and maybe come. First of all, thank you so much for inviting me. It's a really great conference and a really well organised series of events, and it was fascinating listening to Sir Bob. And I guess I wanted to make a sort of overarching view about this systemic change, and then talk very specifically about the role of business, and then very specifically the sort of ability of the financial sector to influence this, because I was fascinated listening to Bob. I mean, this extraordinary blueprint for a complete change in our economic system that we know we need. But if you think about, the whole history of the last 5,000 years of economic development, we have never had a global blueprint for anything. The only thing we've ever really had large blueprints for was sort of, regional wars. And so I think, the challenge is that whilst we might understand the systemic changes we need to do, there are no mechanisms to deliver them. So all of our multilateral processes are non-binding. We have economies that will cooperate in regional ways, but but not always. We know that there is a big separation between what governments say they want to do and what they can actually achieve, particularly in a democratic system. And so the gap between perfect and deliverable gets ever bigger. And if I may be rather provocative, I disagree very strongly with Bob on the point about carbon removal technology, because we don't have time to do perfect. We have to do everything now, in my view, in order to try and inflect the Keeling curve. And then, but to then bring this down to the sort of more specific topic. So when we talk about the sort of the change that we need, we tend to think about it at WBCSD in 3 buckets. How do we reduce emissions? How do we remove emissions? And how do we adapt to the inevitable changes that will come even with the temperature rises of over 1 degree that we've already seen? And of those 3, there is not nearly enough conversation about adaptation, which is one of the great reasons that we're meeting today. And it is fascinating that even though we see report after report, including the great piece that came out on the 25th of January from the Climate Adaptation Summit, that says very clearly this is going to be a massive economic hit. And the assumption that government is going to pick up the tab for this is completely flawed. We still are not challenging ourselves to understand exactly what, how we actually measure this, this challenge, so that then we can start to manage it either with urgent mitigation or indeed with insurance. And what we see at the World Business Council for Sustainable Development, which you will know, as you'll remember, has been around for 26 years. It's the place where the world's most ambitious global companies come together to really deliver on the sustainability agenda. And we don't just do the convening, we focus on the how. One of the big how pieces that we want to work on now is how do you take the climate disclosure frameworks are developing and make them granular, make them useful, make them transparent, and make them standardized. Because at the moment, if you look at any corporate report, even those who say we are disclosing climate risk, there's a lot of qualitative stuff that will relate to 1 or 2 projects, but the actual understanding of the exposure to these changes is not consistent. And there is also, I think, a very dangerous assumption that this is all going to be somebody else's problem because it will happen in the global south and it will affect primary agriculture. And if you look at the Committee on Climate Change report in the UK, as a UK minister, I was extremely proud of the work we did in bringing forward net zero legislation, and we needed our committee to do that. They have just published a very punchy report putting the UK government and UK businesses on notice that this is not a developing South problem. This is a problem for all of us to face. So, so I hope I've hit some of the answers, but we need to, I think, in a world where governments want to lead but don't, in a world where you see corporate action really building up, and frankly, a world where the business sector, I think, is much better at pricing and discounting risk and actually starting to work on it. I think there is an enormous, almost imperative for the private and the financial sector to be forging ahead. And I'll finish with one thing that, since I think the first one was in 2014, we have had numerous coalitions set up to focus on adaptation. Some of them have been very successful, but they just, we never seem to get cut through. So I feel a real imperative on behalf of WBCSD and our members to really convene the corporate sector around this adaptation challenge and provide the numbers so we can start to measure the scale of the problem and then hopefully manage it. Thank you.
Good, thanks very much for those introductory comments. And I think the reduce, remove, adapt is a very appealing slogan that the World Business Council has. With no further ado, I would like to ask Mary Diron from Moody's. Just can you describe how today already climate change, but also in the future further environmental or biodiversity and ecosystem risks are reflected in the thinking of Moody's, and more particularly also in the credit rating of companies, of municipalities, so sub-sovereigns and sovereign credit rating? And also what kind of weight you give to preventions versus basically the cure after the fact?
Yeah, no, thank you. And I think I'll echo some of the points that Claire has made. So as rating agency, our priority, our mandate is to assess, inform investors about credit risks, about what factors may impede an issuer, be it a government or a corporate, capacity to repay their debt. And in that framework, then environmental risks definitely feature and increasingly strongly. And environmental risk include climate risk, whether it's physical climate change, carbon transition, as well as what we put under a label, if you want, of natural capital. So we have a few other considerations that we look at, such as waste and pollution as well. And we really, ultimately, our goal, as I said, is to really to estimate the risks, the threat to an issuer's capacity to repay their debt. And so we do that by measuring the exposure first. So in terms of natural capital, it will be the impact that a corporate, for instance, has on natural capital, on its environment, as well as the dependency. And that's particularly relevant for some sovereigns, for some governments, some countries are really dependent on natural capital. And we've started to publish some scores, what we call ESG scores, with an E part and a natural capital, a physical climate change part, to explain that more transparently. And what we find is that in terms of, as far as corporates are concerned, the extractive industries are really at very high risk in our terminology. So we have about 12 sectors that account for $2 trillion of rated debt that are at a very high risk from natural capital exposure because of the impact that they have on the environment. On the government side, what we find is that we have a number of governments that are reliant on natural capital, and that natural capital is threatened by various actions, climate change or other actions, deforestation, for instance. And so that's a threat to livelihoods, in some cases a threat to life, and hence a threat to credit. In all of this, I think very quickly we led to linking the environmental side with the social side of the risks. And I'll take and one particularly striking, but I think telling example, we rate Solomon Islands. It's an archipelago of islands in the Pacific, extremely reliant on forestry as a source of income, as a source of livelihood. And the common estimate says that within the next 15 years, forests will be depleted in the country. So the country, without any very, very rapid actions and decisive actions by the government, but really by other partners to find new sources of income for the population, then the country's population is facing really very difficult times. And that has already implications on the social side. We're seeing at times protests, frictions between the population and the forestry companies along that, both in terms of the threat to their future income, but also in terms of what is perceived to be a threat to the social fabric of the country and the culture there. So, and that's something that we find in many places, really the environment and the social side being very closely linked together. My last point would be then when we look at all this and talk to governments about what actions they are taking, I may come back to that later. There are certainly actions underway, and in particular as far as the accounting evaluation of natural capital is concerned. But the point that Claire made about the lack of global coordination and the track record of the global institutions maybe not being particularly proactive in that area, that is something that we're seeing as well, and the difficulties that come with that to really fully account for the global externalities of depletion of natural capital. That so far we're not seeing much sign of progress on.
No, good. Thanks very much, Marie. So the accounting and valuation, I think also the metrics is a very important part, and we'll come back later on in the discussion. I would like to give the word to Margaret Kulow from WWF. Not only have we worked together as organizations quite a bit, but I think also the work that WWF is doing on high biodiversity fields together with other NGOs is a very important one when it comes to how we can protect as businesses also. So as part of the sustainability risk framework, for example, at Swiss Re, this has been for a very long time an important factor. Margaret, I would be interested when you look now, you have been also contributing to the thinking on the TCFD as this was establishing private sector led. Now we have the move to the task force on nature-related financial disclosure, and you play a fundamental role in that. Could you describe a bit what is your hope, what is your view on how this is developing, and how do we measure and make progress on that very concretely that leads to action?
Thank you very much, Martin, for the question. Thank you, Miriam and the Geneva Association for bringing this together. The earlier panel was a great discussion, and certainly appreciated the comments from Sir Robert Watson as well. I think maybe starting reflecting on the Task Force on Climate-Related Financial Disclosure through the lens of this new Task Force on Nature-Related Financial Disclosure. I think there are a couple of things I'd like to highlight. First, as Sir Robert Watson also highlighted, the climate and nature are closely interrelated crises. So the climate crisis essentially has come about as a result of our overuse of one of the critical services that nature provides to people. That's using and storing the emissions that we produce. We've produced far more greenhouse gases than nature can absorb or mitigate without negatively impacting back on ourselves in the form of rising temperatures. And the TCFD identified a risk to the financial solution in this overproduction of GHGs and in the economic transition that would need to occur to correct it. It posited essentially that with more awareness of such risks, better information, we talked a lot about data in the earlier panel, investors could and would then make different decisions and better facilitate a smooth transition away from carbon heavy assets. So that those TCFD recommendations now are being more actively taken up. We even have some experience in certain jurisdictions with mandatory reporting to see now that there is some evidence of portfolio decarbonization that actually has come following those disclosures. So we have some reason to believe that that theory of change of having greater information around the set of risks can lead to a reduction in those risks in the financial system. Second, I'd say there's much greater awareness in general of the shared crises of climate change and nature loss. I think one of the elements of that, the fantastic Our Planet series from Netflix and Silverback Films a year and a half ago, together with WWF, it really landed well with audiences around the world. And the COVID-19 pandemic has certainly made businesses lift their heads and think more about what environmental risk exposure really means. We believe there's growing interest among investors as well as consumers and even your employees in supporting business activities that not only tread more lightly on the earth, but also think more proactively about improving the state of our natural world. I think we talked a little bit about what the solution set looks like already today. And we recently worked with the Economist Intelligence Unit to start quantifying this growing, what we'll call eco-awareness. And I think the last point I'd make on this is this task force on nature-related financial disclosures has an important role to play in supporting nature-positive decision-making, both by providing a framework for business to disclose and act on nature-related risks. That is, the dependencies and the impacts of business on nature. I think one thing we learned, again, back to the experience of the TCFD, is that the process of discovery for businesses and by extension for financial institutions is important as they ask questions about their risk exposure, what information they have, what information they need, what data they're missing, and what is in fact material to their business either now or foreseeably in the near future. That same process of discovery will need to occur with companies and financial institutions as they think through their nature-related risks in their lending, investing, insurance activities for this purpose. And the framework that the TNFD will develop over the next 2 years should provide a strong foundation for that set of discovery. So I think it's been an interesting journey for sure over the last year and a half with our partners, the UNDP, the UNEP Finance Initiative, and Global Canopy, and pulling this together with an informal working group of 70, some financial institutions, corporates, some regulators, having this discussion. How do we move from where we are to where we want to be using this great experience of the Task Force on Climate-Related Financial Disclosures?
Thank you, Margaret. I think we will come back to the TNFD definitely, and also I think how can we move from eco-awareness to eco-actions which make business sense and integrated. To Chip Conley from AXA XL, I think you have a very interesting and fantastic job title, Head of Biodiversity at AXA XL. And could you elaborate a bit on how the insurers can identify and assess emerging environmental topics, and also what we heard in the previous panel, as well in the keynote from Sir Bob, how do you address interconnectivities between climate, nature, and related environmental emerging topics?
And thanks, Martin, and indeed, thank you to the Geneva Association for allowing me to speak today. Look, I think that, well, of course, at AXA we're an investor as well, but I will keep it to the underwriting side in these opening comments. I mean, I think if we're looking practically, then of course, underwriting strategies, of course, can reflect an insurer's commitment to contributing to climate change mitigation. And I think that also can be linked to the terms and conditions really of insurance contracts as well. And with that, it's possible that we're able to adjust pricing accordingly. I think that important, it's maybe an example of this is, we signed a statement in 2017 to not insure vessels deemed to be linked to illegal, unreported, unregulated fishing, thereby really trying to, reduce the multiple threats that practice has on the biodiversity in the ocean itself, but also other social and economic impacts as well. I mean, that alongside decreasing claims, we hope, liability and reputational issues. So I think there's some evident links to I suppose, sustainability and corporate responsibility of strategies within underwriting. And then from a policy perspective, I think it's probably worth noting that the EU legislature has invited the EU Commission and member states within its adaptation to climate change strategy to develop a framework that enhances the use of insurance against climate-related risks, and indeed promoting insurance disaster schemes to encourage users to invest in adaptation. But of course, as has been mentioned already today, this all needs to be based on data. And I think at this stage, there's perhaps a lack of understanding of how to utilize that data when we're talking more specifically about climate and biodiversity, more maybe. And then I'm also aware of the fact that that this issue, I wouldn't say it's an issue actually, the need for collaboration across not only the insurance industry but also with the NGO community, with governments, with the multilaterals, is absolutely critical to providing and identifying the roadmap to create the landscape from which we can move forward. And of course, I think that well, one of the things that I'm working on at the moment is I co-chair the Ocean Risk and Resilience Action Alliance, which looks to drive $500 million worth of investment into nature-based solutions by 2030 around coasts in more vulnerable geographies around the world. And that's very much working with the insurance industry, so the likes of Swiss Re and Willis and ourselves at AXA, but also the G7 governments, the Global South, which is absolutely critical, alongside the multilateral agencies and banks as well. All of those, we see the use of insurance as being a critical element of being able to de-risk some of those investments, and indeed being able to restore, where necessary, nature where we think it has a critical role from a protective standpoint alongside everything else. Well, I can go maybe into more detail about that through the questions too.
Thanks a lot. With that, so I think you highlighted the critical role of insurance in de-risking, and I think I want to come back to that, and also the role of data. And probably we should also discuss, when data are not available, how do we work with proxies to make nevertheless progress? Michelle, you have a very rich background on the investment side, but are also very active in the Net Zero Asset Owner Alliance. You have many collaborations that you do in the insurance world. I would be interested from your perspective, how do insurers identify and assess emerging environmental risks when you look more now towards really the nature-based risks, and how can you apply an investment approach with a preventive measure, and what are important key elements of that? And perhaps you can also have a side comment on the underwriting, as we are mainly today interested here in the underwriting side as well.
Thank you, Martin, and thanks for having me on this panel. I will try and concentrate not on the limitations, but on what can be done, because I really do believe that, yes, challenges are huge when talking about nature as a whole, and it goes far beyond climate change. But I cannot agree more with Claire's statement. We should not wait for perfection, and we need to already start acting before everything is completely quantified measures are there, and you can value the services of nature, and you can even price them. Before all of this is done, we really need to start to deal with unknowns. And there are some basic principles that we have already applied to climate change that can be broadened to nature as a whole. First of all, I think one very important point is the double materiality assessment. It's not only about the risks we bore and the dependencies to nature, it's also about the impacts that we have. If we only concentrate on climate change, tackling transition risk is a way to protect natural catastrophes business in 10 to 20 years from now. If we're able to maintain global warming below 2 degrees or 1.5, we indirectly, as investors, protect the underwriting business. So this look-back effect should be taken into account when performing these assessments, and that's where the double materiality is really key. Now we are again in unknown territories, so we need to stay agile, to be curious, to experiment, and to collaborate. It's because, and as was already said before, it's not only collaborating between us as insurers, it's really collaborating with all people, organizations that try to push the envelope and find methodologies. It's not there, but we already have minimum material to start some analysis. We can mix top-down and bottom-up approaches. It's really about understanding what may be at stake, even if not quantified. Qualitative assessment on companies that may be at stake in nature-related issues can already be analyzed and identified within our portfolios. But the most powerful tool that we have in our hands is engaging. We need to engage to drive companies' behaviors. We need to engage with them with clear topics, be it deforestation, be it plastics, water-related topics. We have to talk with them to drive their behavior to a more sustainable way of doing their business. We also need to engage for more transparency with investees. If we want data, we need to be clear on what we need. We need to collect this data, to collect the information. TCFD has been key, and TNFD must be as key as TCFD has been. One point which is quite important for us insurers is to collaborate on both sides of the balance sheet. Once we have identified our investees and we start engaging with them, we always talk with our P&C colleagues to make sure that they have the same messages when they engage with their clients, if it's the same companies we are talking about on the asset and the liability side. What the Net Zero Asset Owner Alliance has really told us, and what we've learned, is really that if we want to be impactful in the real economy, which should be the ultimate goal, we need to combine targets and engagement to make sure that we finally make companies change their business model. We can already do it on nature-related topics, even again, if we don't have the data, if we don't have aligned methodologies, we can start working with them. And we need to leverage upon innovation. We have seen some developments around sustainable linked bonds. It's weak for the time being, but it's up in our hands, investors, to start having frameworks that are much more powerful to make sure that investees finally benefit from the change in their own business model. It's too shy today, but we should try and work to make those frameworks much more robust. Taxonomy, with its do no significant harm, is also a tool that we have in our hands to make sure that we start to address these topics. So as you see, nothing is set in stone, but we can mix up some existing material to start and build a more robust framework that will be enriched over the next years.
Thanks a lot, Michelle. I think you shared from Claire the drive and need to be pragmatic. Not everything will be perfect, but I think the important is to move. We have now a couple of minutes at the moment to go into further questions. So I have some further questions for you, but also to the audience. If you have any questions, please use the Q&A function and just write in any questions that you might have. I try to bundle them. Or raise your hand, although because we are many, it might be a bit more difficult to see who is raising the hands. So back to Claire, and I want just to combine it with Michelle. I would like really to go once more on this reduce, remove, adapt slogan that you have at the World Business Council, and how could that look like, which you already explained quite well on the climate side, but how can it play out on the nature-based assets, and how can you also think through what are the key actions that you think need to be triggered now to really make progress?
Thank you, Martin, and I've been fascinated to listen to people's contributions, and you're absolutely right that so we, we've been focused about solving for, well, stopping emissions. Now we're net zero. Now some of us talk about climate positivity, and we sort of understand why and we understand how. The conversation about nature is, I think, still at an earlier stage. It's at the bottom of the S curve. It's about sort of why, I think, at this point. But what we're starting to see is this, the three-stage approach is sort of, stop destruction, protect and enhance. And the good news is that both the most ambitious governments and non-state actors and companies want to solve both of those issues simultaneously. And also, we haven't talked at all about the global inequity problem, but climate positive, nature positive, sort of equity positive is now the real, and by the way, this is the new WBCSD strategy. So luckily we're across this. And of course we really lack metrics and data on nature, but again, it shouldn't stop us. And I was nodding enthusiastically to Michelle's point, because look, well, the World Business Council wrote the Greenhouse Gas Protocol back in the day along with WRI, and it started off as a group of organizations coming together saying we need to have a carbon accounting methodology like cash accounting. There isn't a regulatory body to do this. Indeed, there isn't a global organization who can be the keeper of this, but it shouldn't stop us. And I would never for a moment suggest that the private sector should be both the producer and the regulator of these standards. But you have to start with a group of large organizations. They can be public, they can be private, who are prepared to collaborate on taxonomy and then disclose and commit to disclosure. And I think one thing that's very striking in the climate space, and this may come as a shock to certain audience members, is there is no central repository of corporate decarbonisation baselines or pledges. So people think that they are all aggregated in the nationally determined contributions. They are not. NDCs are averages that bear no resemblance to corporate footprints. So all this work we are doing collectively to understand our greenhouse gas emissions and report on them is not being captured anywhere. And that is a huge challenge. And we urgently need to create some of these global institutions to collate that data. So for me, there is this huge opportunity to show what good looks like, both in the climate and nature space. And, and I'll go back to what we don't have time to wait for the perfect multinational organization to be set up, because we have some of those and they find it very difficult to operate.
Yeah. So I just would like to have Michelle and perhaps Mary to react as well. So what are pragmatic things that should happen and what are the metrics needed? And then I will invite on Chip and Margaret on a slightly different point.
I think it's both about data, about metrics. For instance, a biodiversity footprint that would emerge. There are already some initiatives. On our side at school, we have partnered with Iceberg Data Lab to assess what they call the corporate biodiversity footprint. It's quoted in mean species abundance by square kilometers, and you calculate you assess how much of your portfolio or how many square kilometers have been completely artificialized by the positioning of your portfolio. So it's really a first metric that we are experimenting. I'm not saying that we will use it as our target, but it helps us better understand what we are talking about. In terms of assessment, we are, for the time being, using Encore, Explore Natural Capital Opportunities and Risk Exposure, which is for us really a promising tool because it enables to really spot the type of sectors. You remember I was talking about mixing this top-down and bottom-up approach. It helps the top-down approach. If you identify which sectors are most exposed to this or that type of biodiversity pressure, then you mix various types of pressures and you identify sectors that are at risk, and then you can have a look more deep in your portfolio to identify which companies are within these sectors. Do you have a company in cross sectors that are impacted by several different biodiversity pressures? And with this, you start to reconcile the bottom-up approach and the top-down, and you can spot the companies on which you need type of information. The technical standard that have been released at European level may also help if we standardize, even if it's a couple, 5 or even 5, 6 metrics that are common to all companies, then we start to be able to manipulate this data and build something which is relevant, because ultimately we need to take decisions. As I was saying, we can start with engaging, but at the very end, we will have to identify, as we have done for GHG, the best-in-class companies, to still partner with them, but drop the others. Otherwise, we will never make it.
Thanks. So I decided just to move, because we get in quite a lot of questions from the audience. I decided to move there, and I would like to have Margaret and Chip answering this first question from William Russell. Constraints of financial capital to pay for all the project needed is a mental barrier for faster action. What ideas do you see for getting around this? We don't have the money barrier. So Chip, if you perhaps could start.
Yeah, no problem. Look, I think I wonder what we don't have the money barrier is. I think that there are various barriers in this specific area, partly related probably to how they see the investment with a productive return. And I think certainly if we're talking about nature-based investment, then understanding what that looks like is pretty difficult at the moment, because there are so few projects out there that are investable. And that's one of the focuses for Aura is about identifying investable projects that investors can actually get involved in. And I think that part of that is also possibly about that going back to this data question about not having enough data to actually quantify the risk. So I wonder what the reason for we don't have the money is, because there is money available. It's just a case of identifying and breaking down the barriers. And perhaps it's also about the fact that there's, the time scale with which to get that investment back is possibly a little bit grey as well. So I think the one of the ways of doing it is through blended finance. So bringing together, private sector investment alongside, government sector or the governments and philanthropy. And I think that by being able to drive that through that blended finance approach, I think that we'll start to see more money driven into the area.
Thanks, Chip. Margaret, perhaps from your perspective, having worked on finance from a WWF side, what would you say are some constraints that actions are not quicker taken when it comes to financial and capital flows?
Well, I'd say first, you need to look at not financing the things that are harmful. And one interesting way to think about the gap of finance available for biodiversity is the flows of funds that go to activities that are biodiversity negative. And one source of funding for biodiversity positive activities could be actually less money traveling to things that are damaging to biodiversity. And there was a very interesting report put out by the Nature Conservancy, the Paulson Institute, and the Cornell University Atkinson Center that basically looked at this gap and divided it between, the sort of negative flows like harmful agricultural subsidies, harmful fossil fuel subsidies, for example, and those thinking about those as a potential source for funds for biodiversity positive activities. At an individual institutional level, there are a lot of tools already available to make better decisions away from harmful activities. I think it was mentioned already, there are insurance industry commitments on related to natural world heritage sites. For example, the International Finance Corporation Performance Standard 6 on biodiversity already provides a pretty good way to screen investments against harmful activities. And then we need the supportive policy environment and blended tools, as Chip mentioned, for the nature positive investments. And we see a lot of activity there too. So you've got the, for example, Land Degradation Neutrality Fund, which was just put together a couple years ago, managed by Mirova. There's a new Dutch fund for climate and development, which combines debt, equity, and support for the deal development to identify investments that could, with a blended instrument, become more investable. So I think there's a lot of activity both on the tools you can use to reduce, both as an individual and at the policy level, to reduce negative flows, and tools that you can use to increase positive flows even now.
So very interesting. Both you and Chip said there's not a lack of finance available, but it's probably directing it to the right side. Mary, we have a question which perhaps is interesting for you. So for countries where we have poor ESG practices, it was mentioned here, Brazil in this question, which I wouldn't agree completely that overall it's poor, but just from a rating agency perspective and the effects that ESG might have on the country, how underwriting and investment policies of insurance companies could push insurers in countries with such poor ESG practices, and how do you see that just from a rating agency perspective?
Well, I think what we're seeing, and that builds on to the remarks that Chip and Margaret made, what we're seeing at the macro level, at the country level, frameworks, accounting, valuations are being put in place. Institutions like the World Bank are doing a lot of work with countries, including Brazil, to value natural capital, integrate that in some cases, to look at the pros and cons, if you want, the benefits that would accrue to the country from maintaining the status quo versus the benefits that would accrue from stopping the status quo and preserving and maybe even restoring. And so putting it together some frameworks that allow these comparisons and then allow policymakers, governments to take more informed decisions and more transparent decisions. I think that the transparency aspect of this is very important. So we're seeing that, and that can then be used by the insurance industry and other participants there in financial markets to value risk and participate in these initiatives. So that's relatively recent, I think, over the last few years. But certainly, I think at the, as I said, at the macro level, at the top-down level, there is increasingly some information analysis that is put together. What typically that does is really focusing on what is specific to the country at stake. So in the case of Brazil, it will be focused on the Amazon and deforestation there. In the case of a country like Morocco, it's been focusing on fisheries and the preservation of marine life and the benefits that would accrue with that. But for those really who accept that lack of that heterogeneity, that nature is very, very diverse, wide, and it can be difficult to compare like with like, then some information is certainly available.
Yeah. So thanks a lot, Mary. A very quick question. As everybody thinks about the final statement, and I want to hear like 2 actions what insurers need to do to address the drivers and impacts of environmental and nature-based risks, and 1 wish which can be really a bit further out. While everybody prepares that statement, which should be only 30 seconds to 1 minute, I want to quickly ask Michel and Chip. There's a question: how are insurers actively working on new insurance products that would help to protect and restore natural capital at scale? And I think this emphasis at scale. Could you give a very quick answer to that?
Yeah, well, let me start very quickly. So, well, thanks for the question in advance. So I think part of this is needed, well, as we talked about before, about data and the real requirement to understand how we can develop new products. And so one of the things that we're working on is a coastal risk index to integrate mangroves and reefs into our risk models for the first time. That will allow us really to start to think about how we can utilize insurance products almost as an ecosystem interruption policy. So similar to what Christian was talking about earlier about coral reef insurance, we're working with the Nature Conservancy at the moment on development of a mangrove insurance policy in the Caribbean and in the US. And so there are, and of course, it's fine, as Christian said, it's fine having this one example, but of course we need to scale it and replicate it as quickly as possible. And again, that's where we need to be collaborating with others within the industry and across governments and the multilaterals as well. So there are sort of new products coming available. I'm sure that Swiss Re is also working in that space too.
Just given time, I think we need to go to the final round, but thanks a lot, Chip, for those answers. And I think there's a lot going on in the industry to scale solutions now in this field as well. So I would like to start with Claire O'Neill on that question that I just mentioned. So 2 actions, 1 wish on how insurers can address the drivers and impacts of environmental and nature-based risks going forward. Be please very brief in your comments.
I wanted to actually build on what Chip said, because I'd written down products and proof, and I'd written down COP27, because look, ultimately we can read numbers that like the one that said, the adaptation gap in developing countries is 140 to 300 billion by 2030, and everyone says, well, that's a really big number, and goes back to their day jobs. Understanding what the cost of insuring that would be, I think, helps to frame, and it's presumably uninsurable at the current level, although as Chip suggested, we can parse this up into buckets of insurability. I think the challenge we've got now is because of the kind of removal in time and space of us from the climate and nature problems, they're just really difficult for people to absorb. But once you start knowing what it costs to insure your house, and how that cost drops if you put in a smoke alarm, then people start to take steps. So there's something about quantifying this in today's time and money that I think really helps us break through. And the other thing I wanted to bring in is my time as a minister in the UK government. We set up Flood Re. We actually went through a process of trying to work out, where does the government actually get involved, because government is not going to be the insurer or the rebuilder of last resort in very many of these challenges, but there are areas where we can have now public-private government schemes, and we don't see enough of those. And I think if we can start to show those, that's important. Sorry, I'm pushing the cat away, who's most unprofessionally joining our summit. And lastly, I wanted to raise COP27. COP27 will be an African COP. We're going to likely hold it in Egypt, Ethiopia or Ghana. The whole question around adaptation risk and who pays and water shortage and food shortage and energy transition is going to be much more powerful when we're actually in a host country that is in a very different state. And I think that will, if we're thinking ahead, that will help us frame and articulate very much more this conversation.
Thanks a lot, Claire. Mary?
2 points really. One is that there is really increasingly evidence coming through valuations, nature-based accounting. So I think collectively we can grasp that, use that, cut that in different ways to deepen the analysis and the understanding. From that, I think will come, at this stage, big question, which is what will be enough? And I think Claire raised that earlier. What does good look like? I think we do need to go into these questions, starting to propose some answers with specific case studies and pushing the envelope in that direction.
Good, thanks a lot. Margaret?
Thank you. I would say first, every business, every financial institution, every insurer should be using the tools that are currently available to examine their own nature-related risk, what dependencies and impacts your activities have on nature, both directly and indirectly through supply chains. I think the journey to the solutions starts along that path of discovery and awareness of the risks that you're already exposed to. Insurers can follow the insurance industry guide, as I mentioned, to the Protect Natural UNESCO World Heritage Sites, follow the principles for sustainable blue economy. These are tools, guidance documents that already exist to help. I think next comes the engagement for change. So you shouldn't wait for your customers or your clients or your investors, for that matter, to leave, looking for someone who's more focused on sustainability, or for regulators to develop a new set of regulations into this, all of which are coming. You need to support now nature-based solutions, investment on the investment side and in the underwriting. This can be an excellent way to be part of the solution. I think that mangrove example that Chip gave is great. It's a mitigation effort, it's an adaptation effort, and it's a people effort, both in protecting people from storm surge, the impact of storm surge, but also as a nursery for fisheries. So I think there's my wish then for the future to close is this full systems thinking about how our activities, business and the financial services to those businesses and to us as citizens and to our economies have to be completely integrated. We have an opportunity in the COVID recovery to lead a recovery that leaves us individually, as societies, as economies, and as well as our environment, more resilient to the next crisis.
Thanks, Margaret. So Chip and Michelle, very brief comments from your side.
Very, very brief. Well, I think I sort of echo what's been said before, but I think one of the major things is about valuing nature. So actually putting a dollar figure on it. And Margaret's just sort of talked a couple of things there. You know, there's the carbon sequestration element as well, of course. And I think if you are putting a value on nature, then you're more likely to manage and maintain its integrity. Both from an economic standpoint, but also from an environmental and social standpoint as well. So I think that's critical. I think that we within the industry need to be able to develop scenario analyses. I think there's a real critical role that we can play in terms of building awareness of emerging risks and integrating this into our commentary. And then I suppose the final point is about public-private partnerships and the work that we can do together. Whether that's the IDF or Insure Resilience or whatever, all those different examples and others are really crucial to promoting nature-based solutions as a critical pathway forward.
Okay, thanks. And Michelle, before I hand back to Mariam.
I would say raise awareness internally is critical. Foster transparency by investees is as critical as internal work, and then collaborate and engage.
Cool. That was short. With that, thank you very much for a fantastic panel, and back to Mariam to close us off from the event.
Thank you very much. Thank you, Martin, for great moderation, and to the panel. On behalf of Geneva Association and Swiss Re, I would like to thank our panelists, keynote speaker, and all the participants for engaging in this rich dialogue. We hope you have found it fruitful and insightful. Recording of the session, along with the summary and the slides of Sir Robert Watson, will become available on the webpage of this event. We will continue our research and our activities in this area, so stay tuned for future announcements. And as I close the event, you will receive a short survey to provide your feedback about this event to help us improve what we bring to you. And I want to thank you again for your engagement and wish you all the very best and a great summer ahead. Thank you and goodbye.